Hi, it's Steve Klark with Klark Software. Thanks for joining me today. I want to talk to you today about a circle of protection that you can put around your client's lifestyle, assets, and income. And we're going to do that with three proposals in Klark Software: the human life value, the long-term care costs, and the disability income profile. So what we're going to do is we're going to load some saved cases here. And to do that, we're going to click on File in the top left. We're going to click on Open Case, and I'm going to go down to Samples, Personal. I'm going to highlight that, and I'm going to click Open. And I want to go down to the Human Life Value, which is the fourth icon down the right-hand side. Here's the Human Life Value. We're going to click on that, and you see we have a saved case in there. And your Human Life Value is the present value of your career earnings. And what we do is, in this proposal, we calculate John Smith's career earnings. Our program brings that number back to today's dollars, gives it a present value. And that present value of the career earnings is his human life value. And then we take John Smith's existing life insurance and we apply it to the human life value to see what percentage of his human life value is covered by life insurance. So we're insuring income. That's what we're doing here. So here's the inputs. They're minimal, but they do the job. And you're going to see he's 35, 65 is our comparison age. He's making $100,000 a year. He has $150,000 of insurance. Income grows at 3% annually, 35% tax bracket. He's getting 6% on his money. We're going to go down to the bottom right here. We're going to click on the Preview tab. And here's the graph. And I'm going to max this for you. And at the top of the graph here, the green is his income. John Smith's from age 35 to age 65. And in that time frame, at the end of the first sentence here, you're going to see he's going to earn a little over $4.7 million. That's a future number. Our program takes that number, brings it back to today's dollars, and this 2.6 right here and some change, that's the present value of his career earnings. That's his human life value. And then what our program does, in the last sentence, we're going to take that $150,000 of life insurance, and what it's going to tell us when we apply it to the human life value is he only has 5.66% of his human life value insured or covered by life insurance. Very small percentage. He's underinsured. So here's a quick way to tell someone if they're in need of additional life insurance. And in this case, I would say he is. But it's a quick snapshot that you can work with your client, and again, it's going to tell them if they're adequately insured in terms of life insurance. We have a more in-depth tutorial on our website about the human life value. I want to move on to the long-term care costs, which is down at the bottom right here, this LTC. We're going to click on that, and we're going to load the save case. We go File, we go Open Case, and now we go Sample, LTC. We highlight that. We click Open. And all we're going to show here is the cost difference between self-funding your own long-term care versus buying coverage. Because if someone's going to self-fund, there is the possibility that they might have to tap into some type of asset they have, whether it's savings, IRA, 401k, to cover the long-term care costs. It is a possibility. So John Smith is 60. His life expectancy is 80. He's looking at 5 years of long-term care. We're going to assume it's the last 5 years of his life. What I'm going to do is I'm going to change the annual cost for long-term care. I'm going to go to the 2021 national average. It was $96,000 a year for the cost of long-term care. That's the national average. It will probably be different in your area. We get a 5% inflation rate on long-term care. The net cost of money, what that is, it's the net annual rate of return he gets on money, John Smith, on his money that he saves to self-fund his own long-term care. We had 6 in that box. I'm going to lower it down to 3. We're going to say we're going to give him 3% net on any money he saves to self-fund his own long-term care. We got a premium of $52.19 a year, and we're going to pay it for 15 years because again we're assuming The long-term care is needed the last 5 years of his life. So when he turns 75, he would start using that long-term care, and the premiums would cease to be paid. You can also put a second plan in. Different coverage, different premium mode. I'm going to go down and click on preview here, and I want to show you something. It's a 2-page proposal. The first page is basic information about long-term care to bring the client up to speed. You have the option to take this out of your presentation, and I want to show you how to do that. I'm going to close the preview, and I'm going to go to this last input, print long-term care facts. Hit the down arrow, I'm going to make that no. Now you're going to see we made this a 1-page proposal. At the top of this little spreadsheet is the data we inputted. We have the age running down the left-hand side of the spreadsheet. The next column over is the annual long-term care costs, grown at 5% annually. So if you remember, at age 60, that number was $96,000 for that year. It's growing at 5% annually. So what you're going to see is the growth in the long-term care costs. Because again, we assume it's going to be the last 5 years of his life. Here's what it's going to cost annually each year with that 5% growth. And this is the wake-up call right here. John, you're looking at a little over $1.1 billion in long-term care costs. How are you going to pay that? If he self-insures, he's got to save this amount annually each year for 15 years. Plus, that money has to earn 3% net each year. If it did, then the self-insured payments and the 3% net annual growth would cover this cost right here. It would pay for that. However, we did not put that 3% growth in this column because we want this to be a net number here. We want it to compare favorably to this number here, which is 15 years of premium payments. So in a sense, we have two net numbers next to each other, and here is your cost difference between self-funding your own long-term care versus buying coverage. And you do have to remember, you have to model a product that's going to cover all or a lot of this cost right here. So you're comparing apples to apples. But here's your cost difference. And what we're talking about here is when you purchase that long-term care coverage, it's going to be protecting assets. And again, whether it's saving, IRA, 401k. Couple other things. If someone says, well, if I don't use it, I lose it. When you look at this number, if you use one year of the long-term care only, you're ahead of the game. The other thing is, look at the cost difference between each year. It's roughly about $49,000. Well, you could take some of that difference in the 49 grand, buy an additional long-term care policy, buy a life policy that could be used to pay off any remaining long-term care debt. So there's a couple of different things to point out here. Okay? We're going to close this and we're going to go up to disability real quick. It's the second icon down the right-hand column. We're going to click on that. We're going to load the save case. File, open case. We go back to samples, personal. We highlight that and click open. And all we're going to do is a very simple before and after scenario. John, here's your present disability coverage, and then we're going to propose a supplemental. And we're going to simply quantitate it for him. So you're going to put in his name. You have an optional line of text, whatever you want to put in there. You're going to put in his present monthly income. Does he have a present monthly benefit? If he doesn't, you have to put 0 in. But we'll put that 1,000 back in. All you do is you put the number in and you hit the tab key. We're going to propose another $1,000 a month in supplemental disability insurance. You're going to see you have the option to make the numbers all net or all gross. We do not do the calculations, but we suggest go all one way or the other to simplify the proposal. When we click on preview, you're going to see John Smith's current plan at the top of the page. He's got a $1,000 a month benefit, and in this gray box, it's insuring 29% of his income. As we move down, here's the proposed plan. It's the green in the graph. It's going to bump his total monthly benefit to $2,000 a month. And now in the gray box, you're going to see that 59% of his income is insured. We've just simply quantified this for him. And it goes back to this question, if you were to become disabled, can you get by monthly on 29% of your income? So just to recap here, 3 proposals that we can do in 3 pages. We've got the human life value that insures the lifestyle. We've got the long-term care that insures the assets as well as takes care of the caregivers, keeps them out of the equation. And then we can go up to the disability where we insure income. As always, if you have questions, please reach out to me. I appreciate your time. Take care.